Good afternoon, everybody. Let's do this disclosure real quick. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRECIPIC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. And here is the position disclosure once again. All right, so interesting day today with the market. Kind of more of a digestion day. Very sloppy intraday price action. You can see we had a little bit of a common gap to the downside. That gap was pretty much filled here for the SPYs within 5 minutes, and then we spent the entire day being kind of sloppy. This 368 is the spot that we were discussing for the SPYs in the morning meeting. I really think it's a little bit more of a range, and that range probably extends itself down to 367.50 or even a little bit below that. So with the sloppy price action that we had today, we did break down below that at one point here, midday, which actually led for a really good short with the IWM, which was leading. I'll get back to that in a second. But we managed to close above. So at the end of the day here with our daily candle, we really don't have too much to talk about. Kind of a doji day, a little bit of a rest day, stuck in this equilibrium zone. So SPYs, as of right now, down 0.7% on the day. Qs are down 0.5%, and the IWM was certainly the leader to the downside, closing down 1.65%. That weakness in the Russell is a little bit notable. It seemed like the underlying feel of the market today was much weaker than what the S&P is showing us, and that's probably because Netflix performed so well, which was helping to boost up your mega cap stocks to some degree. And then energy traded great also. Energy traded great. Netflix was up a ton, and even though these FANG names were, flat to down kind of on the day, they're probably better than they would have been otherwise if it wasn't for Netflix. So I think that helped the SPY kind of hold up and give us this doji day here in this equilibrium area. We're still above this 368, which is a good sign. But this day didn't really give us too much to write home about as far as the market price action. One of the things that I was emphasizing a bunch of times today was just being defensive today. We didn't have a strong edge with kind of how the market was trading. I did not feel that the market was on my side for any long trades that I was putting on. I know, and particularly when we broke that opening low and we were down here, and I know that eventually we made highs and things looked a little bit better. But the IWM never confirmed it, and this IWM is something that we should really study. The Russell has been the leading index for sure this entire calendar year. I would argue going back even further than that. And the IWM was very weak today, and I think that this is a better gauge of like the real underlying market today as opposed to what we're seeing in the S&P and the Qs, which I think are disguising the weakness because of how good Netflix earnings were. IWM really weak, down 1.65%, I think is what I just said on the day. But you could see it early on. The IWM opened down more, didn't bounce as well as the SPYs and the Qs, right? SPYs were able to pretty much immediately bounce back to flat. Qs bounced flat to green right away. And the IWM just gave a little bit of an oversold bounce on the common gap to the downside, creating a pivot into the ADMA and then immediately making new lows. And this bear flag here looked pretty bad. We were discussing in real time the possibility of this bear flag breaking to the upside, which happened, but this pretty much stalled out at highs. We couldn't. What I kept saying was, I'll feel comfortable about my longs. I'll feel comfortable being more aggressive with longs if the IWM can really clear highs. And it just didn't happen. We kind of made equal highs here, more or less came back down to lows, digested at those lows. We were making kind of a descending triangle here. That's what I called out to the team. And I called out a rare, so I really don't call out too many trades at noon. Noon is usually the time of day where I kind of suggest that most traders should avoid trading too aggressively or too actively. I called out a short in the IWM / long in TZA, basically the same thing, at 12 o'clock on the breakdown of the intraday pattern. And that was a good trade. Again, just this IWM weakness was really the sign. There were times here when you were looking at the SPYs or you're looking at the Qs, and Qs are making highs on the day, SPYs are making highs on the day, even like off this candle here at 11:35, we're building up this wedge. This could break to the upside. Like the SPYs and the Qs, it's several times today. If you're specifically just looking at the SPYs and Qs, you might be thinking like, hey, maybe I should be a little bit more aggressive with my longs, but the Russell just never confirmed it, and that's so key. So when I did not have confirmation from the Russell, really starting from the beginning of the day, pretty much from the beginning of the day, like we found some good longs, and I'll get to the trades that were solid in a minute. But the thing that I kept wanting to emphasize is, any trades that you are able to find, you should probably not be going like max risk on anything today. It's just not there. We don't have the layers of probability on our side. By the way, I'm doing a probability class tomorrow at 12 o'clock where I will talk about layers of probability. And one of those main key layers of probability is the market. If the market's not on your side, then you need to do less. And with where we traded today, honestly, I don't think that the market was really on our side for longs or shorts. Again, the IWM short call out at noon was pretty good just off of that relative weakness, but it's hard to even be aggressive with that when the IWM is above 170. 170 has been a pretty big level for the Russell, and it's been kind of holding up above that. It held that all day on the inside day over here. So hard to be too aggressive to the short side, hard to be too aggressive to the long side. So without that confirmation. And that's how you preserve capital. Today's a day where you generally don't want to push things. It's one of, so I've got a class. Oh, this is exciting, actually. I can say this. I have a class that is called like my 8 themes of trading success or something like that. And one of those themes is knowing when to be aggressive and knowing when to be more passive in regards to your trading. Knowing that the stars and the moon are lining up and really, going for it and being active and putting on extra risk and really pressing those buttons and trying to drive it home versus recognizing, hey, you know what, my edge really isn't here with what the information that the market's providing me. I need to take a step back. I need to trade less. I need to have less risk. The ability to recognize that is a huge part of overall trading success. And anyway, I filmed that class like over a year ago, but for whatever reason, there were, I don't know, an issue getting the right compliance disclosures or something. For whatever reason, it was never added into the class system. And I think as of today, it was actually added into my class system. So, the professional traders here at T3, awesome, Amber, glad to see that. If you have access to it already, you should be able to go in and see a new class in your training program classes that you did not have previously. And for the people who are here as a guest this week and you're deciding whether or not you want to be part of the team, well, guess what? You have an extra class that you're going to be having access to as well. I think it's the 8 themes of trading success or something like that is what we're calling it. And again, knowing when to be aggressive and knowing when to be passive is certainly one of those. And today was just a day. Today was just a day to not be aggressive. With that said, we had some pretty good trades. The IWM short / TZA long at noon on kind of the breakout or breakdown of the pattern was solid. The one thing that I had confidence on in the morning meeting today was energy. We spent a lot of time in the morning meeting talking about the energy trade. We talked about XLE, I think over 82.50. We talked about ExxonMobil. This was one of my favorites for today because I love this pattern and it got upgraded. So you kind of had multiple layers of probability behind you on this ExxonMobil. This 102 was a really, really good trade. The only issue I take with this ExxonMobil trade is that it was a lot of risk to trade it right. If you bought 102 through the open, you really kind of had to give it down to lows. So you have to assess if that's the right amount of risk. But from a probability perspective, our layers of probability, again, tomorrow's class, it was like everything was kind of lining up. The only thing that wasn't fantastic about Exxon, again, was the amount of overall risk you had to take on the trade through that 102, kind of giving it to lows. But that ExxonMobil worked fantastically well. Mentioned Chevron in the morning meeting. Chevron worked incredibly well. The one that shook out, unfortunately, was this Oxy. This Oxy, someone else mentioned it. It might have been Sharir. I feel like this Oxy hasn't been trading as well recently. We know that every time it's getting down to like $60, it seems like Warren Buffett keeps adding to his position. But above that, it hasn't been trading well. So Oxy was the one that just shook out the opening low here and didn't really work out, but all the others did. PR we mentioned as a trade through like $9 to $9.05. It's a cheaper one, so maybe not fantastic follow through, but 40 cents a follow through when it eventually did kind of go there. So the energy trade was definitely the trade today, and it was the thing that I think we had the most amount of confidence coming into the day about. So, it just shows. One of the things I think that we do a fantastic job here on ProDesk is those morning meetings, is that big picture game plan. It's incredible how consistently right we are with the thought process on where we're expecting the money rotation to come in, and how we're expecting the market to trade, how aggressive we should be or how passive we should be. All those major factors that are setting you up for trading success throughout the day are something that we're really, really consistent with on our morning meeting every day. Energy was super on point. Outside of that, things were certainly tricky. Paying attention to relative strength and relative weakness in other issuances, like some of the tech stocks, was one of the things that I was trying to do when we were looking at this market early in the day. So Snap was one. I called out a Snap low. Even I was hesitant with it, and I think I specifically said, again, going back to aggressive versus passive, that I like the trade, but probably not with too much risk. We talked about going long off of the 940 low in Snap. So, opening trade here, it starts extremely relatively strong, which is, again, relative strength is one of our layers of probability. It pulls back to the 80 MA, which is our upper band of equilibrium on this time frame. It creates a little bit of a tail off of that. So we talked about going basically long off the tail to see if this could be a pivot low that leads to trend continuation. It really fought the market here. This was so hard. If you look at what Snap was able to do versus what the market was doing at like 940, 945, the market at 940, 945 is breaking down through lows. The IWM is getting absolutely crushed at 940, 945. So any longs that I'm looking at, I really wanted to see that early relative strength, watch the pullback, and then if the market can just hold in, some of these are probably going to be really good trades. But again, you can't trust the market. And if you can't trust the market, what does that mean if you're taking the Snap trade? And I don't care that it worked really well. It means that this is not a trade that you should be putting on a massive amount of risk for. And that's really important. So that Snap did hold. It gave an inside 5. The inside 5 broke to the upside, and then eventually it caught a pretty nice bid up here to $11.40 off of, you could have been in this thing off that call out for probably less than 10 cents worth of risk, and it gave 60 cents worth of reward before eventually failing also and kind of making new lows. This Snap was a little bit crazy. And then there were some others that were a little bit more of a struggle. AMD, we were looking at this low right here at 940 as something to be long versus. This is one that was trying to hold in really, really well, and you can see eventually it exploded once it got some market cooperation. But the market just kind of forced this one to fail if you were long off the 940 low that was called out. If you gave it to lows, it did hold for you, but if you just gave it to the 940 low, unfortunately the market caused your trade to fail. And again, that's what I'm talking about. Like, we're trying to combine the fact, like, okay, this AMD here is really relatively strong. Like, this thing looked really good to me after the 940 bar closed, but if I'm just fighting the market, it's going to be so hard for that trade to work out. And it was doing that. It was fighting the market. Snap was fighting the market. And this one, unfortunately, if you just gave it to the 940 low, pushed you out before really working, and that was all market related. But this is what we talk about, and I guess I'm giving little teasers for tomorrow's class. This is what we talk about when we talk about risk skew. Risking more when more factors are on your side, risking less when less factors are on your side. So what's on your side with this trade is that relative strength, is that semis were trading well today. What's against you is the market. So I got a layer of probability that's for me. I got a layer of probability that's against me. That the sun and the stars and the moon are not fully lined up on this trade. It doesn't mean don't take it. I liked it. I think a few of you guys were in it. But that one layer of probability of that market weakness caused that low to break, and this X is a little bit of a shakeout before it eventually goes, as opposed to another one that actually was able to hold in. Was Apple, and don't be distracted by yesterday's price action. Apple was another one. You can see this is today, very strong off the open. I think someone asked me about Amazon off the open today, and I didn't like how Amazon was trading versus Apple. Apple was so much stronger, gaps down, leads the market higher, fills that gap, pulls back, gives a higher low here at 940. This is the similar type of trade pretty much across the board. Whether it's Snap, which Snap's probably the best technically because it's trading all the way up here and just pulling back to equilibrium, or AMD or Apple, these ones that basically were able to be leaders as far as filling the gap and getting back to green. They give a technical pullback here, but the strength is there. We're not just buying on the way down in this pullback. We're watching our strong stocks to see if they give a pivot point that you can go long versus. And I didn't see this one actually. One of you guys called it out. I don't remember who it was. But after this third bar basically closed, someone was like, "Oh, Apple's another one that's like holding up really well." And I typed it up. I'm like, "Oh yeah, for sure. Like this is another one where you could go long versus the same pivot, the same trade." And Apple was one off of its relative strength that was able to give a decent move. But where this one failed eventually also when we had that market weakness around noon with the IWM kind of rolling over, and we had the TLT get hit when the Treasury auction hit out. It eventually broke that low. But these are the types of trades that we want to look for, and the more of those layers of probability that you can get on the side of your trades, the higher the success rate will be, and especially if you can combine that with a good risk reward. So we're looking at if the market's on our side. We're looking at our leading pieces of information, which is the IWM, the semis, the dollar, the treasury yields. We're seeing how many factors are on our side at any given point in time, and then we're assessing the risk reward on any trades that we might want to get into to see if it can work out or not. So there was definitely a few that we looked at that were like an AMD situation where it's a good trade but the market pushed you out. There were a few that were like Snap or Apple that gave kind of decent moves off those lows, but even those the market eventually caused them to push down. And then once again, the real winner. I don't know how many times I've said this year. The real winner once again is these energy stocks. They're the best looking daily charts that are out there. This XLE looks fantastic. That ExxonMobil looks fantastic, and you got even more things were just on the side of your trade here for these energy names, and that was pretty much where the money was at. But again, the thing to draw as a lesson from this is know when to be aggressive, know when to be a little bit more passive, and we were right off the open to err to the side of being long versus short as long as we were holding up above 368. But at the same time, as we held that 368 and there were some opening long trades off that 368 and off of that pivot, at the same time as that worked, we never really had true market confirmation that the market was actually on our side today to kind of make it go. So Amber, I was told that it was added to both. I guess I'm wrong. So people who are actually on the team, you guys can. All right. Well, if it's not there, it'll be there soon. So that's pretty much all I've got for you guys today. Not a ton because the market's not giving us a ton to really work with. But like always, I am happy to answer any questions or look at any names that you guys want to look at or anything else that I can do to help you be a successful trader every single day. This is where I turn it over to you guys. The forum is yours. Anything I can do to help contribute to your success, I want to do it. Alcoa, what's it doing? Getting smoked. Alcoa's getting smoked. IBM, not bad. And where's Tesla? Tesla off 3%. Not awful, but not great either. We'll see. Pretty mixed. For the most part, these earnings reports I think have come out pretty good. But pretty mixed today. Pretty mixed after hours today. All right, let me see if I missed any questions. Looking through the virtual trading floor here. I'm 90% of the time aggressive, says Sharir. I need to chill. Yeah, 90% is probably a little too much. Snap is tomorrow after the close. Yeah, I think XLE could have followed through as well. Energy looks great. This XLE, it's a big move, but it's not so big that it can't have a day two. But whenever it comes to those day twos, like tomorrow everyone's going to ask me about buying XLE, and I'm going to say you should already be in it. especially if we like gap up. Everyone's going to want to be in it tomorrow who wasn't in it today, and I don't like chasing day twos. You want to be in day one and then hold stock overnight and then just keep getting paid for the good work that you did today when day two and day three comes around. If we gap up tomorrow on XLE and you're looking for the longs, you're chasing after, the break was 82.50 that we were looking at. If you're buying 85 tomorrow, you're chasing $2.50 late. I really don't like doing that. It doesn't put you in as good of a situation from a risk-reward probability perspective. Why was I looking at Snap today? So I was looking at Pins, Snap, Google. I know that they're not directly impacted by Netflix. Netflix is a little bit more subscriber based, even though they're going into advertising. But first of all, after hours yesterday off of Netflix, the names that performed best were a lot of these user-based stocks. So again, even Netflix versus like Facebook or Snap, which is more advertising based and less subscriber based, have different business models. But at the end of the day, one of the most important metrics that you look at when you're looking at Netflix or Snap or Facebook or Pinterest is those daily active users, right? So Netflix was able to really perform, and then after hours we saw Pins caught a really big bid. It was up to like 24.25 after hours yesterday. Snap was trading well last night as well. Facebook was another one that was actually relatively strong off the open today. Pins was the biggest disappointment to me of the day, honestly. And Pins gave a nice opening bounce, but this Pins just stayed red all day and really just did not cooperate. So it was basically off of Netflix that I was really looking at these today. And Snap was trading great pre-market. It opened up green. Everything else gapped down. You can see the relative strength in so many different ways. So that's why it was on my radar. I mentioned in the morning meeting the potential of buying through $11. And maybe people took that off the open. The only problem with taking that off the open is you have to give it down to lows to trade it properly. So if you want to take, and this actually is not too bad. It's not too good either. 26 cents worth of risk here through $11 versus lows. If you took that, it eventually works well enough to at least get your risk covered. The better trade was that kind of pullback execution trade. It was much lower risk. But that's why it was on my radar today. That question was from Sebastian. Next is from KG. What do you think about someone trading for a living starting in January 23? Just want your opinion, perspective. So I don't think that the date necessarily matters. Whether you're starting in October 2022 or January 23 or August 2010. I started, my first day at T3 was August 23rd, 2010. I know that because it's my birthday, and I remember that my first day ever at T3 was on my birthday. So that's when I started. So, the date doesn't matter so much as just making sure that if you are going to start trading for a living, you really want to be putting yourself in the position for success. So one of the things that I tell people all the time is, if you really want to get into trading for a living, you got to make sure that you've got your kind of life covered. Trading for a living, the income is highly variable. It's highly variable, and you have to be able to budget for that. There's going to be periods of time potentially where you do very, very well for yourself and you make lots of money, and then you might have months where you basically don't make anything. And you can't just go out and party like it's 1999 every single time things are going well, because I promise you that you will have periods of times when things don't go as well. All traders who do this long enough will have trading slumps. It's a natural part of things. As a matter of fact, if you ever speak to anybody who is telling you, yeah, I've been trading for a long time and I've never lost money and things have always been great, that person is lying to you, is trying to sell you something, and you should run the other direction away from that person. I love talking about my mistakes. I love talking about the times that I've struggled, with the periods of times when I haven't done well, because my hope always is that people can learn from the mistakes that I've made over the course of my career and that they can be better. So the first thing is to make sure that you're budgeting properly going into starting to do this for a living. And especially if you're a brand new trader, I don't know, KG, how much experience you have or what your background is. I don't really know anything about you, though I'd love to learn more. It's not unusual for brand new traders who start like trading, professionally or whatever, as they're going through that learning curve, even for the people who become successful, to not make any money the first few months that they're in the business. So the worst thing that you can do for yourself is say, hey, you know what? I'm going to start trading professionally, and now it's your first month trading, and you say, oh my God, I got to make $4,000 this month in order to keep a roof over my head. If you get started doing this and that's where you're at in life, you're setting yourself up for failure and heartache and pain. So, I really recommend that you set yourself up properly, when you're coming into this business, so you can get through the learning curve in a reasonable period of time, that you're not giving yourself excess undue stress on your shoulders, and that you're, really open-minded to learning. And then when things do go really well, which hopefully that happens, don't necessarily expect that those amazing times will always last forever in exactly the way that they have. So yeah, hope that helps, KG. From JK. JK. What's up? Sorry. I know you don't like Boeing. You said you don't like the way it trades. Any reason in particular? Also, what do you think about it going through 140? I just find that Boeing is very sloppy from my experience trading it in the past. I find that it gives a lot of false signals. And on top of that, it can be a little bit more expensive, a little bit thinner, with a little bit of a wider spread. So it's just kind of like a combination of things that usually has me steering clear away from it. I've just seen so many false signals over the years from this type of stock, from this stock in particular. False breakdowns, false breakouts, failed patterns. I think that stocks in a lot of ways are like people. They all have their own unique personality. So, some stocks are thin and some stocks are thick. Some people are thin and some people are thick. Some stocks, I think they trade very clean. The technicals tend to trade very clean. And some stocks, they kind of trade a little dirtier. They don't respect their levels in the same way. I find Boeing to be a little bit spready, so a little bit thinner sometimes, and a company that just does not respect its levels. And that makes it difficult for me to trade. So I usually don't go to it. I've not had a tremendous amount of success with the stock, and it's just not in my sweet spot. So what do I think about it above 140? I think it looks okay. You got the gap fill that's kind of coming in at 140, so 140 is a little bit of resistance. You can see it tailed above it today, I guess, and kind of came back down, standard for the stock. If I scroll back further, I can see that 140 to 140 to like 142 has been a big level in the past, back in June. So maybe it's not as specific as 140. Maybe it's more of a range, and I can even see today it went as high as 140, 120. So it's still kind of within that 140 to 142 range. I think the stock looks okay. If it's starting to get above 140, it's starting to round back up. One thing that I do like is that it respected its June lows. In this September-October pullback, it's well above the June lows. That is showing you that there is some relative strength, and that could make it a name that you want to focus on for the long side. But yeah, so broadly, I think above that 140 to 142 area, that it looks decent. I don't trust it. So hope it helps. From Mike. Believe this contrary to an earlier statement. Oh, this is just Tesla information. Cool. From the other JK, how do you identify a day one in a stock? So you know it after the fact. Oh, so like how do I identify that tomorrow will be a day two? Is that the question? Like today was a day one, so therefore tomorrow is a day two? I can't know. A lot of times when you've got really big breakouts with really solid ignition bars with confirming volume that closes positive Maribozus, it's not unusual that you see a day two, or sometimes even see a day three. I have no idea if it will be or not. Sometimes the next day is a consolidation day. I actually prefer if the next day is a consolidation day if I'm not long, because that can give me a new setup. If I'm already long, yeah, then I definitely want day two and day three and day four and day five and day six to occur one after the next. Usually you don't get that many in a row unless you're trading Jinko Solar back in 2020. So there's no way to know tomorrow that'll be a day 2. And because there's no way to know, if you're trading it tomorrow to the long side, you're probably setting yourself up for a worse risk reward and probability of success. So that's why I don't want to go after day 2s. I want to be in day 1. If it closes well, swing it. And then one of two things happens. One of a few things happens, I guess. You have a good probability of getting a day 2, in which case you just get paid. You probably have an equal probability of getting a day 2 as you have getting some sort of rest day, whether that's an inside day or a little bit of like a, poking through today's high but not giving continuation type of day. So both of those things happen with a pretty high probability. Or another thing that can happen, but it's much lower probability, is a complete reversal back down to lows that gives like a king-queen top and totally fails. That's your lowest probability, but it can happen. So for me, if I'm in XLE from 82.50 as an example, or 82.75, and you caught this great trade, you want to swing this. And you want to do it from a win-win situation, which is exactly what we spoke about in yesterday's class. So now you're in this from a win-win situation. Whichever one of those 3 situations happens, it doesn't matter to you. If you get the day 2, you make more money. If you get that sideways day, then you don't make anything or lose anything at that point. You stick with the position. Maybe that gives a setup for further continuation in a couple of days, and that's still great. Or the lower probability situation of it coming all the way back down, you get stopped out. That's fine too, because it's a lower probability situation. You put yourself in the position to make significantly more money. You're in a win-win. So at the end of this trade here, you're still probably making money. If you're extremely greedy, you're break even, and you'd have to be extremely greedy for that. Otherwise, what's that? So yeah, I hope that helps to trial JK as opposed to non-trial JK. From Silver, do you only day trade 3x leverage? This is a great question. From Silver, do you only day trade 3x leverage ETFs like Labu and Soxel because of the decay, or will you hold them overnight? So I do trade them both intraday and overnight. I've been in Labu for a little while. Soxel I'll swing as well. You really need to have an understanding of, though, if you're trading those 3x leverage ETFs, that decay will occur, especially if you're holding it long enough, and you have to be able to account for that. At the end of the calendar year, if XBI is up 10%, Labu will not be up 30%. It'll be up 30% less whatever the decay is from it. So you can still get, extra juice to the upside being long, Labu for a swing, and you certainly saw that in a really strong uptrending environment like we saw for basically 10 years until the start of this year. It can give you extra bang for your buck on the upside. But if you're just dealing with a sideways market with volatility, it's going to be pulling against you over time, and if you're wrong, it could potentially be going against you even faster. So I am involved in them, but a lot of times, so people ask me about TQQQ and SQQQ all the time. I don't really ever go long SQQQ. I prefer to short TQQQ. Now, what I don't know the answer to, and this would be a really good thing to know, and I probably should know it, if it's just a day trade, then whatever. I probably prefer to be short TQQQ. I don't know how much the decay is really going to matter on an intraday basis. It's probably very, very marginal. On an overnight basis, if it's a longer time position, then that's going to benefit me. But what is the cost of keeping the short overnight? If there is one, if there's any type of overnight short margin interest or locate costs or anything like that, which TQQQ is usually easy to borrow. It's usually not too bad. But what I don't know the numbers behind, and it probably would make sense to know, is the cost of TQQQ overnight versus the time decay that's going to be in your favor by being short it, if that makes any sense. So yeah, I don't usually buy SQQQ. I usually prefer to short TQQQ. but I say that without actually knowing the math. So if anyone wants to do the math, I'd be curious to know the answer. Opening drive playbook. What is yours? My favorite is when it coincides with the daily. Me too. That's my favorite. It seems like you tend to get into stocks you like pre-market, but just curious in your approach. I shouldn't say favorite. I should have said higher probability setup. Yeah, Mark, that's my favorite opening drive trade also, is basically breakouts through daily levels that are happening at the open. That might be my favorite trade, period. Or breakaway gaps above the level also, which is also going to kind of be an opening drive breakout trade. It's just, you just trade it a little bit different. That's the number one thing I'm looking for at the open every day, is stocks that are breaking through levels ideally with volume confirmation, ideally with relative strength, and ideally with the market on my side. That's the number one thing I'm looking at or for off the open. And that's why I love daily research. I love doing the daily chart research. It's such a big, important part of my morning process. But most of what I'm doing when I'm doing my morning research is I'm reviewing every single stock that gets posted into the virtual trading floor, everything that had news, earnings, upgrade, downgrade, or anything that anybody mentioned, and I'm just mapping out the levels. Oh, this thing had earnings. Oh, it's set to open up right near this beautiful, clear resistance level. Bam, alerts out. Writing it down in my Excel spreadsheet to present to you guys in the morning meeting. And then bam, it triggers or it doesn't trigger. If it triggers, that's it. That's like, Netflix yesterday, or 2 days ago, or was it yesterday? I don't remember. Through that 235. I guess it was 2 days ago. XLE today, ExxonMobil today, Snap today through 11. All of those opening breaks, that's my number one for me. I love it. You just got to make sure that the risk is appropriate. Sometimes the risk is a lot. So that's that's the trade I'm looking for in the first 5 minutes. And then after that, I begin to look for actual setups that come in, like hammer continuation dojis that can happen, starting at like 9:40, 9:45 a.m. like what we saw with Apple today, like what we saw with Snap today. Earnings names that are giving nice bull flags or bull pennants that form built out after a big initial great upside candle. That digestion that happens for 15, 20 to 30 minutes, something like that. That's other stuff that I start looking at as well. But none of those are going to be happening between like 9:30 and 9:35. And anything I'm doing pre-market, if I wasn't already in it, is usually just going to be a feeler. Usually. Not always, but usually. From PS, I am assuming you have losing weeks. I sure do. Does it ever translate into losing months? Unfortunately. Yeah, I have losing months sometimes. I try to keep them to a minimum. But yeah, I have losing days. I have losing months. It's all about the risk management. And it's, I learned a while ago from good traders, and I've now seen this to really start actually happening with me. I remember talking to Mark Sperling a long time ago and learning from him that he typically makes like 90% of his year over the course of, like P&L wise in the year, over the course of like 2 to 3 of the trading months. And then the other like 9, 10 of the trading months, he's, kind of treading water. He's flat. He's making a little bit of money for himself, kind of eking out a living a little bit, throws in a red month once in a while. And I've started to see that happening from me more also, where I'll have, a few periods of time throughout the year where I absolutely crush it. And then, a lot of the other times it's not really lining up, or, well enough how I trade by this point. I'm looking for those big moves to come in. I'm not getting the follow through. I'm having, break-even trades. I'm consistently not getting that follow through. I throw in some losers once in a while. So I might be treading water or eking out a little bit of a living for myself, or, throwing in a red month once in a while. But then when things really do line up, I also know how to crush it, to be honest, if you're asking about me personally. And there's been a few periods of times this year where I've just done, really, really well for myself. I really caught that July-August move. I really caught that market. It's funny, we're in a bear market. This has been the worst year, I think, that I've ever traded since I started in 2010. But even with that said, I've made most of my money to the long side at the right times and the right spots in this market. So, yeah, losing money happens. It's part of working in probabilities. We just want to keep it to a minimum. Good stuff, KG. You should, don't be afraid to reach out to T3 Trading Group about if you're starting to do this for a living, actually trading. Make sure that you're trading through T3 Trading Group. HD saying, traded Boeing for decades. Boeing is a terrible trading stock. Yeah, that's how I feel about it. PS saying, I trade Boeing very consistently. Almost 100% losing trades. Yeah, might be time to put it on the do not trade list. Is Brett from Brett, is XLE having an inverse head and shoulders bottom breakout? An inverse head and shoulders. So an inverse head and shoulders, and I don't know what time frame you're looking at where you're seeing it. I don't know if you're just referring to like right here where it's breaking out. It's probably what you're looking at right here. And then this is like a neckline. I'm actually okay with this. Really, an inverse head and shoulders is a reversal pattern, so you should be downtrending into the head and shoulders pattern as it comes out, and then reversing the downtrend. I could see you making an argument that we trended down from June, kind of, and bounced back, and it's a little bit more of a consolidation, but it came from higher prices, and therefore it's still an inverse head and shoulders. I could see that argument being made. I'm okay with it, but we just want to remember, in technical analysis, there's only two types of patterns. And maybe some people are saying, well, you got head and shoulders and cup and handles and bull flags and pennants and triangles and wedges and whatever else you're able to come up with. Taco, what's the one that Pat taught me last year? The taco doji sandwich or something? Or maybe that was just because we were trading on Cinco de Mayo. I'm still learning chart patterns myself. There's only two types of chart patterns. There's continuation patterns and reversal patterns. A head and shoulders is an example of a reversal pattern. A bull flag is an example of a continuation pattern. The root of all technical patterns is the definition of trend. An uptrend's a pattern of higher highs and higher lows. A downtrend's a pattern of lower highs and lower lows. So what you should be doing whenever you're looking at any pattern is assessing the trend into that pattern. I think, and this goes back to what I was talking about yesterday, where people just memorize chart patterns and think that they can be successful. It's not enough. You have to understand the supply and demand dynamics that are actually making that up. You have to understand, I guess that's it. You have to understand supply and demand. So I see people all the time incorrectly call out bull flags and bear flags. They see a consolidation and they say this is a bear flag or this is a bull flag, but it's just a consolidation within a consolidation that's not a flag. Depending on its location in the chart, it could. I would call that a bullish consolidation or a bearish consolidation. I separate that from a bull flag or a bear flag. I think that a bull flag has a higher probability of success than a bullish consolidation. But the key difference is between a bullish or bearish consolidation versus a bull flag or a bear flag is what it looked like going into the pattern. If it uptrended or had momentum into the pattern, that's a bull flag. If you got this big range, then it ranged into the middle of the range and consolidated, that's not a bull flag. It's a consolidation. And it could be a bullish consolidation if it's a tighter consolidation within the upward portion of a bigger consolidation. That's what I would call a bullish consolidation, but it's not as good as a bull flag. So yeah, again, just going back to head and shoulders, it's the question that brought up this little rant. Is there a trend going into it? And again, yeah, you can maybe make this argument from highs, so I'll live with it. From DJ, when I study price action, I sometimes find myself picking apart every candle on intraday charts. While it helps me get a gist of how a stock moves, I sometimes wonder if I'm reading too much into noise, probably. Spending too much time and energy nitpicking. When you look at intraday charts after the market closes, are you only focusing on key spots, or do you look at everything? I'm generally only focusing on key spots. And this is another thing, by the way, DJ. This is another thing that's really one of the more nuanced things that's difficult to work through as you're going from being a newer trader to being a more experienced trader. I remember when I was a newer trader doing what you described. I would nitpick like every little portion of every candle. I would, and especially in the tape, because I did a lot of tape reading once upon a time. Nitpicking every little thing I see in the tape. Even then, let alone now, there's just massive amounts of noise and nonsense and junk in the tape that just can give you false signals that it's meaningless and you can overread it. And the charts are the same thing. With that said, I do think that candlestick analysis is important. And by the way, I have a candlestick analysis class in the boot camp or training program or whatever we're calling it these days that people can get access to if they don't have access to it already. I do think that candlestick analysis is important. Reading the candle itself or the signals that the candle is providing is really important. And I have entire trades that are based off of that. But you have to make sure that you're reading the important candles. How do you know if a candle is an important candle? First of all, you can never know with 100% certainty, but what's going on coming into that? Was there a trend where this candle's in a position where you think this is the spot where trend continuation can happen? That's an important candle to read. Was there massive downside capitulating volume and then a hammer candlestick comes into play? That's a really important candle to read. Or is it the intraday price action of I got Tesla up on a different or was it this? Are you reading every candle in this? This is trash. Whoa, I just got a crazy print from shop. I wish. Or are you trying to read candles within this nonsense? You don't want to be reading candles. You can't be nitpicking these candles. They're meaningless. There's no trend. There's no momentum. This tail here on this hammer means nothing. This tail here on this shooting star means nothing. All these candles mean nothing. So you have to read the candles when they're important. And the difficult thing that really comes a lot of times with experience is knowing when the candles are important and knowing when to say, you know what, this stock is done. It's not giving me an edge. I should not be overreading those candles. So I hope that helps. From Rich. Some of those triple leverage ETFs are small dollar values, so have to get more size, and that can create other leaks like slippage. You can take some non-leverage and get bigger dollar moves as opposed to percentage moves. Yeah, so I prefer actually to trade things that are a little bit cheaper so I can have more size. More size is going to give me more game planning ability. So if I have a choice between something that's expensive and something that's cheap, I'm usually taking the thing that is at a cheaper price because I want to take more actual tier size, because that more tier size is going to give me more game planning flexibility. More game planning flexibility is something that's going to make me money. So from Wong. If a bullish Maribozu at the high of the day requires 2 instead of 1 bearish bars to completely negate it, is it still a queen, king, and queen? Technically, no. And if so, will you look at will you have the same level of conviction if it took 2 queen? No. We're assuming looking at a 15-minute TF. So I'm going to say no to that. It'd be helpful to look at an example if you have an example. I'm going to say no to that. But if it's 2 bars there, I really need to see what the formation of those bars looked like. But negating Maribozus is always meaningful. However it happened, negating a Maribozu is always meaningful. If it's over the course of 3 bars, I think it's a little bit different than over the course of 1 bar. But there's still meaning behind it. Just maybe that meaning is a little bit different. And then again, Friday, Tesla 10.7 at, I assume you're looking at a 15-minute chart. 10.7. I can't go back to the 7th on a 15-minute chart. Right, what's this date? Monday. No, I can't see it. Can't see it. Can't see it, unfortunately. But, yeah. If you do see another example that I can see, let me know, and I'll happy to take a look. But I think that the negating of Maribozu, especially if it's a volume confirmed Maribozu, is always important. But King and Queen's a little. That's a very specific thing, where you break out and immediately fail on that next bar, and it really traps people. It's like the same thing as a shooting star, but over the course of 2 periods. The Doji burrito. Bill knows. Yep. For Mike. All because of Elon's preference of a junk company, Twitter over Tesla, trading caviar for crackers. Yeah, I've been ranting about Elon Musk with Twitter for ever since it first happened. If you're a Tesla shareholder, you should be really upset about this. It's distract. I mean, one of the reasons I thought Jack Dorsey was a terrible CEO for Twitter is because he only cared about Square, so he wasn't focused on Twitter. And the reason why he primarily cares about Square is because all of his compensation comes significantly more from Square than it comes from Twitter. But he's the CEO of both, and he, in my opinion, really mismanaged Twitter. And now you got Elon Musk, CEO of Tesla, SpaceX, Solar City, Boring Company, Neuralink, and Twitter. And you know this whole Twitter thing, getting put into court, all that, is definitely taking away from his ability to be able to run Tesla properly. Not to mention, taking away from his finances to be able to run Tesla properly, and causing him to have to sell all that stock, which is adding weight to the stock and, more float into the stock, and his selling obviously helps drive the thing down. So, yeah, I think that if you're a Tesla shareholder, you should be pissed about him getting involved in Twitter. It's ridiculous. Yeah. Gotcha, Rich. From Silver, what is the most common and costliest mistakes that you see with traders? The most common and costliest mistake is not obeying your maximum loss. It's probably the most common and most costly. Not obeying your maximum loss, and it's the number one thing that I really find separates people who are successful from those who are not. I spent a lot of time talking about it the last couple of days, so I won't get into too much of a thing about it again today. But you show me that trader where whatever their maximum loss is, they're so consistent on never beating it, and they can throw in the upside days also. I'm looking at a profitable trader. You show me a trader who lets a whole ton of slippage go past their maximum loss, doesn't have money management skills, risk management skills. Let me tell you, your ability to manage money is more important to your trading success than your ability to trade. I'm very confident in that statement. I'm very, very confident in that statement. I'll repeat it. Your ability to manage money is more important to your trading success than your ability to trade. I've worked with people who are phenomenal chartists. They can read charts so well, and they don't become successful because their money management is garbage. And I've seen people who are mediocre traders who can be consistently profitable, like mediocre as far as analyzing technicals and everything else, who can be consistently profitable because their money management is consistently on point. It's the biggest mistake. It's the worst mistake. It's the number one career killer. It's the first thing that you should focus on as a new trader. P.S. I think Twitter has no effect on Tesla's fundamentals or Elon. Elon has multiple other companies, so why Twitter would be a problem? So I can agree with that thought process. But I think personally that Tesla has always been an extremely overvalued company, And if he is selling stock and adding to the float, and people even perceive that he's not involved or focused in the same way, and that's leading to additional selling, anything. The reason why Tesla's been so expensive for so long is because Elon Musk has a cult around him. And if he starts to lose his cult of personality, then his stock will start to lose multiple. That's what I'm concerned about. I appreciate the compliment. P.S. said, I don't know how many new traders in this room. You will not find a mentor who will give you attention and teach you risk management than Derrick. I really appreciate the compliment. From Brandon, what do you think about us bouncing around the zero fib from June lows? The zero fib? Which one's the zero fib? From June lows. I assume you mean spies. So you mean coming back to 262? I'm not a big fib guy who can draw them into. I'm not even gonna do it. Like, we could draw them into the chart. But when you say the zero fib, I assume that you just mean the starting point, those same June lows. So we'll see. That area has been important. That 360 to 362. It got a little bit sloppy in here this month of October. We kind of broke down, snapped back above it, but then held those levels again. So yeah, we'll see if it continues to hold. I don't want to see that level. I don't want to see it get retested, to be honest. Like, I really want to see. I really want to see the bulls, and this might have to wait till we get the mega cap stocks to report earnings. We get Apple and Amazon and Microsoft. I really want to see a higher low come in here on this market. Possibly even today's low being that low, that leads to a break higher that really confirms that we're starting to break out of this descending channel. That's what I really want to see from bulls. That's the biggest thing I'm looking for right now. But you got to let it come to you. Thanks, Boris. Geoff agrees with Elon Musk being a problem for Tesla. Yeah. And yeah, I agree with that too, Silver. That was one of the things I said at the time. He was saying some stuff that, and I really don't like to get into politics on the VTF, so I'm not going to state any opinions, but he was saying some stuff that was, more conservative, like Republican, whatever, leaning in his tweets sometimes. But I would assume, electric companies, it's all about the environment, that more of his buyers lean more liberal than they do conservative, just by the nature of his product. So yeah, all that stuff alienates potential buyers. So yeah, I agree with that as well. But the biggest thing with Tesla's always been, can it grow into the multiple? And I do think that Elon Musk has done an incredible job with Tesla. I don't want to take that away from him. He's done an incredible job turning a pipe dream into the world's most valuable car company. Incredibly impressive what he was able to do, and we see Teslas all over the road now. But what we need to be concerned about now, from a trading perspective or an investing perspective, is Tesla as a going concern going forward. So yeah, all right. Well, gang, it looks like I got through all the questions here. Sorry I couldn't be on the radio a little bit more today. I got caught up with a whole bunch of stuff. But tomorrow morning, we'll assess the research, we'll assess the gap, we'll come up with a game plan for the morning meeting, and I'm doing a class at 12 o'clock, and it'll be business as usual. So have a great night, everybody. Appreciate all of you guys tuning in and paying attention, and I'll see you all tomorrow.